It's that weird dead zone between Christmas and New Year's. Ghost week. Half the world is off grid. Markets are thin. And I told you yesterday, I said, go be with your people. Turn the screens off. I meant it. But I'm turning this camera back on because something just happened that you cannot ignore if you're in silver, or if you're thinking about getting in silver, or if you're just trying to understand why the next two trading sessions could feel like a trap door. So yeah, put the drink down for a second. Give me 5 minutes of your attention. Not vibes, not narratives, numbers. Because silver is setting up for the kind of gap that makes people say, wait, how did it jump $2 while I was asleep? And if the setup confirms, a gap to $77 is not a crazy headline. It's a logical outcome. And if the gap prints, $85 by Monday becomes a question of flow, not fantasy. Let's walk through what the market is actually signaling. Silver just ripped to record territory above $75 this week in global spot trading. That alone is a big deal. But what matters more than the headline is what's sitting behind it. A visible east-west price tension that isn't closing the way it normally closes. When that happens, the next move often isn't a smooth climb. It's a jump, a gap, a violent repricing to catch up to where real bids are sitting. Now listen carefully. I'm not doing the influencer thing. I'm not going to draw triangles and pretend I can see the future. This is not, I think it goes up because it feels bullish. This is, if A is true, then B becomes likely. If B happens, then C becomes possible. We're going to build a chain you can actually audit, and then you'll know exactly what to watch between now and Monday. First, I want you to understand what China is paying in its own physical benchmark. This matters because when the market is tight, Shanghai often becomes the place where procurement stress shows up first. Here's the data point. The Shanghai Gold Exchange silver benchmark print for December 26 shows roughly 18.5 XX RMB per kilogram. Don't worry if your eyes glaze over at RMB per kilogram. That's exactly why we do the math. Because the whole game is hidden in the conversion. Okay, calculator out. We're doing this together. Step 1. Take the Shanghai benchmark. Let's use 18,551 RMB per kilogram as the reference print. Step 2. Convert RMB to dollars using a real mid-market USD CNY rate. On DEX 26, we're around 7.0067, 7.009. So, 18,551 RMB per kilogram divided by 7.0067 is approximately equal to $2,648 per kilogram. Step 3. Convert kilograms to troy ounces. There are 32.15 troy ounces in a kilogram. So, $2,648 divided by 32.15 is approximately equal to $82.35 per ounce. Let that sit. Shanghai's benchmark math is implying an $282 handle. Now, compare that to what most people are staring at in the West. Silver and global spot just printed records around $75. So we're not talking about a $927 spread. We're talking about something more believable, and therefore more dangerous. A persistent $6, $8 tension between where physical style benchmarks are printing and where Western liquidity is pricing the screen. And that's exactly the kind of tension that produces a gap. In a calm, healthy market, that gap gets leaned on. Traders do what traders do. Buy the cheaper venue, sell the more expensive venue, and the spread collapses. That's arbitrage. That's gravity. Gravity keeps global prices from drifting too far apart. But during holiday thin weeks, gravity gets weak. Because arbitrage is not a button. It's a process. And when the process gets jammed by timing, logistics, credit, bar specs, delivery windows, risk controls, the spread can sit there longer than it should. And the longer it sits, the more the paper market is forced to reprice to meet reality. So here's the punchline. When Shanghai prints numbers that imply $82 and Western spot is floating $75, the Western market is sitting under a magnet. And in Ghost Week, magnets don't pull gently, they pull suddenly. Silver gaps to $77. Why $77? Because it's the first catch-up rung that makes sense. Think of it like this. If Western spot is $75-ish and Shanghai math is low $80 seconds, the market doesn't have to teleport straight to $82 tomorrow. It just has to start closing the credibility gap. A jump from $75 to $77 is the market saying, okay, we see the bid. We're not fighting it in an empty room. And holiday weeks create empty rooms. Reuters literally pointed out the move is happening in thin year-end conditions. That's the fuel for gaps. Not because the world changed overnight, but because the order book is thin enough that price can move farther per dollar of buying. Now, the most important part. Who's on the other side of this? because the buyer profile tells you whether a spike is a joke or a regime shift. A retail-driven spike looks like fireworks. Big candle up, bigger candle down. Everyone screams, then disappears. But an industrial-driven bid is different. It's boring. It's relentless. It doesn't care about your RSI. It cares about one thing. Can I get metal on time? Because if you're a manufacturer and you don't get your inputs, your line stops. And a stopped line is more expensive than paying $5 or $8 extra per ounce. That's how real shortages behave. Not like a meme stock. Like a procurement problem. And 2025 has been a year where silver demand stories keep stacking. Industrial pull, tech pull, investment pull. That's not me talking. Mainstream reporting has been pointing at industrial demand and shrinking inventories as key drivers of this move. Now let's zoom into the next 72 hours. Between Christmas and New Year's, a lot of normal liquidity isn't there. Senior traders are out. Market makers run lighter. Risk desks tighten limits. A lot of funds stop initiating new positions, so the book gets thin. That means two things at the same time. A smaller buy order can move price farther. If price moves into key option strikes, you trigger mechanical hedging flows. And that's how a normal rally turns into a lurch. Okay, $85 by Monday. Is it guaranteed? No. Is it possible? Yes. But it only happens under a very specific chain. Here's the chain. Condition 1. Silver holds above the recent breakout zone and does not immediately mean revert under $75. If we see buyers step in on dips and the market refuses to go back to the old range, that's your first tell. Condition 2. Shanghai's benchmark doesn't cool off. If SGE keeps printing high RMB, KG numbers implying low $80 seconds, then the magnet stays on. Condition 3. The Western market runs into an options speed bump because above certain strikes, dealer hedging can add fuel. Let me translate that into human language. If there are a lot of calls sitting at $77.50, $80, $82.50, and price approaches those levels, the entities who sold those calls often hedge by buying futures as price rises. That buying is not emotional. It's mechanical. And in a thin book, mechanical buying can act like a bulldozer. So if we gap to $77 and keep going, you can get a second leg. And that's the scenario where the $85 print becomes realistic, especially if liquidity remains thin into Monday. Because the market is not just trading price. It's trading credibility. When silver hits record highs, it attracts two kinds of players. Player 1, trend followers. They buy because it's going up. Player 2, insurance buyers. They buy because they're scared it will be unavailable later. Insurance buyers are the dangerous ones. They don't buy one dip and disappear. They keep buying because their risk is not price. Their risk is not having metal. And in an environment where Shanghai benchmarks imply higher levels than Western spot, you are basically flashing a sign to the world that says, physical style pricing is firmer than paper style pricing. That sign pulls insurance buying forward in time. Before we go further, two myths that will get you hurt. Myth 1, Shanghai is always higher. It doesn't mean anything. Wrong. Sometimes Shanghai trades rich, sometimes it trades tight. The point is not China bullish. The point is whether the premium is behaving like a temporary holiday wobble or like a procurement bid that refuses to fade. That's why I keep saying, watch the direction, not the ego. Myth 2. If there's a spread, arbitrage will instantly fix it. In textbooks, yes. In real life, arbitrage is a checklist. Do I have access to the right bars? Are they in the right place? Can I finance them? Can I insure and move them? Do I have warehouse capacity? Is my risk desk allowing it this week? Does the delivery window line up with the contract I'm using? When any one of those boxes turns red, especially during holiday weeks, instant becomes later. And later is where gaps are born. Let me explain what a gap actually is, mechanically. A chart makes it look like price moved. But price doesn't move. Price is discovered. It's the last traded price where a buyer and seller agreed. So what's a gap? A gap is when there is no agreement at intermediate levels. You can have $75.10 as the last print, and then the next real seller isn't until $76.20. In a liquid market, that space is filled by dozens of resting limit orders. In a thin market, that space is empty. So when a buy order comes in, whether it's a fund, a hedger, or an algorithm, the order doesn't walk slowly. It jumps. It hits the first available offers. And if the first available offers are higher, your chart gaps. This is why Ghost Week is dangerous. Because empty space on the order book is invisible until you fall into it. And this is the psychological trap. When a gap happens, your brain screams, I missed it. So you chase. You market buy into the air. And then the market does what it loves to do in thin conditions. It whips back, fills some of the gap, shakes you out, and then continues later. That's why pros don't chase gaps with market orders. They use levels. They size down. They let the first hour print the truth. Because in the first hour after a gap, price is not trending. Price is negotiating. Now let's talk about the part that can turn $77 into $80 faster than people expect. Options hedging. Here's the simplest version. A dealer sells call options to traders. If price rises toward those strikes, the dealer's risk rises. To hedge, the dealer buys futures as price goes up. That means rising price, more dealer buying rising price. This is why you'll sometimes see silver stair-step through levels that used to act like brick walls. It's not magic. It's hedging flow. And in a thin book, hedging flow is a flamethrower. So when you hear me say $85 by Monday is possible, what I'm really saying is, if we get a gap, a hold, a push into heavy strikes, then the market can accelerate under its own mechanics. Not because everyone suddenly became bullish, because the machine is forced to buy. Now, to be precise, I'm not saying the world can't move metal. I'm saying the bridge that normally keeps pricing perfectly aligned is not frictionless. There are specs. There are delivery windows. There are approvals and warehousing and financing and risk limits. So during weeks like this, even a $6, $8 differential can hang around longer than people expect. And when it does, price does what price always does. It moves to where the real bid is, not in a straight line, in jumps. If you've never lived through a gap, here's how it feels. You go to bed at $75.20. You wake up and the first prints are $76.40, $76.80, $77.10. No warning, no gradual climb, just a repricing. And the reason you don't get a warning is simple. The market doesn't need your permission. If the sell side isn't there and the buy side hits the tape, the chart doesn't negotiate. It just prints. Here's what I want you watching. Not headlines, not hot takes. Signal 1. The Shanghai implication. If SGE benchmark pricing stays elevated around 18K plus RMB kg, the pull remains. Signal 2. The spread behavior. Not the exact number, watch the direction. Is the gap compressing because the West rises? Or is it compressing because Shanghai cools? If Shanghai cools, this is a holiday distortion story. If the West rises while Shanghai holds, this is a paper catching up story. Signal 3. The first 60 minutes on Monday. If Monday opens and sellers immediately slam it back under $75, the market is still fragile. If Monday opens and dips get bought quickly, the regime is changing. Signal 4. Volatility behavior. If we see sharp spikes followed by shallow pullbacks, that's a strong hands market. If we see sharp spikes followed by deep dumps, that's tourist money. Signal 5. Your real-world check. If your broker shows a dip, but coin shops and dealers don't lower premiums or inventory looks thin, that tells you something about the physical layer. Here's how you know this whole gap to $77, push toward $1.80 seconds thesis is wrong. If Shanghai cools sharply while Western spot holds, the story was a temporary premium. If the SGE benchmark drops back toward the mid-17,000 seconds RMB kg and stays there, the magnet weakens. If Western silver breaks down under the breakout zone and stays there with real volume, the market rejected the higher range. That's not bullish. That's a failed breakout. And if Monday comes with normal liquidity and zero follow-through, no bid, no urgency, no repricing, then the ghost week gap idea becomes a nothing burger. So don't believe me. Audit the scoreboard. 3 practical rules depending on what you actually hold. If you hold physical, your advantage is you can ignore the minute-by-minute noise. Your disadvantage is you can't click sell in 2 seconds. So don't stare at the screen like it's your boss. Watch premiums and availability. If dealers are out of stock while spot is down, that tells you the real market. If you hold ETFs, futures, respect volatility, use limit orders. And if you don't understand how margin works in a $3, $5 daily swing environment, reduce size. This is not a moral statement, it's survival. If you hold miners, expect exaggeration. Miners can rally 10% and then drop 7% in the same week, with silver still bullish. If you're trading miners, you need wider risk bands or you'll get chopped. And for everyone, do not let one candle make your life decisions. The next 48 hours are about structure, spread, liquidity, and flow, not about your emotions. Now this is where people get wrecked, not because silver isn't bullish, because their brain is. Rule 1. Don't confuse volatility with reversal. Silver can move $2, $4 in a day and still be in an uptrend. If you trade it like a slow asset, you'll get shaken out. Rule 2. If you're using leverage, size down during ghost week. Thin liquidity punishes tight stops. You can be right and still get stopped out by a wick. Rule 3. If you're holding physical, don't let the screen bully you. The screen is the paper layer. The physical layer is availability and premiums. Rule 4. If you're in miners or ETFs, expect chaos. They can overshoot both directions. Have a plan before the open, not during the candle. And Rule 5. Stop anchoring to your old mental ceiling. A lot of people still have $30 is expensive baked into their nervous system. But silver already made new ground this year, and it's being driven by a mix of industrial and investment demand that mainstream reporting has been openly discussing. Rewire the anchor. You don't have to be euphoric. You just have to be realistic. Here are the 3 clean scenarios into Monday. Scenario A. Gap and hold. We open strong, tag $77, pull back a little, and hold above $75. That's the market accepting a higher range. In that case, $80 becomes a magnet, and $85 becomes plausible if options flows kick in. Scenario B. Gap and trap. We spike towards $77, the book fills, and we dump back under $75. That's a holiday head fake? If that happens, don't panic, just recognize the market is still hunting liquidity. Scenario C. No gap, then a delayed gap. We open flat, everyone relaxes, then Monday or Tuesday the real move hits when volume returns. That's common. The market loves to make people feel safe before it moves, so don't marry one outcome. Marry the scoreboard? Let me end with the real point. This isn't just silver up. This is a market stress test. It's a test of whether paper pricing can stay in charge when physical style benchmarks and industrial pull are pushing in the other direction. And when the world is in a supply-sensitive regime, the market doesn't give you smooth transitions. It gives you gaps. So here's what I want from you. If we print $77 in the next sessions, don't just cheer. Watch how it behaves after the print. Because the behavior after the breakout tells you whether we're looking at a one-week headline or the start of a new pricing era. And if you're still doubting that silver is in new territory, remember, we just watched spot push through the $75 level on record-setting trade. That is not normal. That is not just another week. That is a market telling you. The old ceiling is gone. If you want, I'll do a follow-up Monday night with nothing but the scoreboard. Shanghai implication, spread behavior, and whether the gap, if it happens, held. No hype, just signals. Drop a comment, scoreboard, if you want that update. And if you're new here, subscribe, because this is the kind of market where missing one session can cost you the whole move.